Gold just crashed $1,200 in less than 60 minutes. Silver collapsed 40% from its all-time high. $6 trillion erased from the global metals market. And if you still think this was just a normal correction, you missed what actually caused it. Welcome to Market Flux. If you are watching this channel, you already know something mainstream media will not tell you. I break down what is actually happening in financial markets, while CNBC keeps you distracted with noise. Subscribe right now because what I am about to reveal could change everything you thought you knew about this metals crash. Let me show you exactly what happened on January 30th, 2026. Gold peaked at $5,608 per ounce. Silver hit $122. These were not just new records, these were numbers nobody thought possible. Then everything reversed in 20 hours. By Friday evening, gold sat at $4,770. Silver crashed to $98.50. On Monday, February 2nd, gold touched $4,400. Silver hit $71.67. That is a 21.2% drop for gold, a 41.1% collapse for silver. Most people think this was profit-taking after a massive rally. They are wrong. The crash was mechanically triggered. The CME Group, which runs COMEX Futures Exchange, raised margin requirements at the exact moment metals hit record highs. Here is what that means in plain language. Think of margin like a security deposit. When you trade futures contracts, you put down a percentage of the contract value. That percentage is your margin requirement. On January 30th, as gold peaked at $5,608, the CME increased gold margins from 6% to 8%. Silver margins went from 11% to 15%. That sounds small. It was not. Traders on COMEX were massively leveraged. They were controlling positions worth millions with relatively small deposits. When margins increased, they had two choices: pour millions more into their accounts immediately or close their positions. Thousands of traders could not meet the new requirements. Their positions were automatically liquidated. This created a cascade. When positions close, it generates sell orders. Those sell orders push prices down. Lower prices trigger more margin calls, more liquidations, more selling. It becomes a feedback loop. This is not theory. The iShares Silver ETF recorded $40 billion in trading volume on Friday alone. That number exceeded the combined trading volume of Apple and Amazon that day. It made the SLV one of the most traded securities in market history. The CME did not stop at one margin increase. They raised requirements again on February 3rd. Shanghai Gold Exchange followed. Markets that were already illiquid became worse. Bid-ask spreads widened. Market makers stepped away. There was no cushion to absorb selling pressure. Now here is the part most analysts completely miss. While retail traders were getting liquidated, central banks were buying. The People's Bank of China stepped in at $4,450. They absorbed physical gold while paper markets collapsed. Sovereign buyers showed up exactly where speculators capitulated. Let me explain why this matters. There are two types of gold markets: physical gold, which is actual metal you can hold; paper gold, which includes futures contracts, ETFs, and derivatives. The ratio between paper and physical gold is roughly 100 to 1. That means for every ounce of physical gold that exists, there are 100 paper claims on it. When leverage unwinds, paper markets crash violently. Physical markets stay relatively stable. Central banks know this. They buy physical. Retail traders hold paper. The crash exposed something critical about market structure. COMEX open interest for March silver delivery was multiple times larger than registered physical deposits. That imbalance is what traders call a ticking time bomb. When speculators control markets through leverage, small changes in margin requirements can cause catastrophic moves. 3 reasons drove metals to record highs before the crash. Reason number 1: Chinese retail speculation. Bloomberg reported that Chinese speculators created a wave of hot money flowing into metals. Prices for copper, tin, gold, and silver all hit records in January. This was not fundamental demand. It was momentum trading amplified by leverage. Reason number 2: dollar weakness. The dollar index hit a 4-year low in late January. A weaker dollar makes gold attractive. Gold is priced in dollars globally. When the dollar falls, gold rises mechanically. Every central bank holding dollars saw their reserves lose value. They bought gold as a hedge. Reason number 3: Federal Reserve uncertainty. President Trump nominated Kevin Warsh to replace Jerome Powell as Fed chairman. Warsh is known as a monetary hawk. He favors higher interest rates. Markets interpreted this as long-term dollar strength. Gold initially surged on inflation fears, then crashed when traders reassessed Fed policy. Silver had an additional driver: industrial demand. Every solar panel uses 20 grams of silver. The solar industry consumes 30% of global silver supply. Electric vehicles need 25 to 50 grams each. Data centers require silver for semiconductors. The silver market ran a supply deficit for 5 consecutive years. That industrial narrative pushed silver above $100. Retail investors piled in. Social media amplified the momentum. Silver became the speculative play. Its lower price per ounce made it accessible. Traders thought they were buying into inevitable demand. They ignored leverage risk entirely. Now here is what mainstream media will not tell you. While retail investors were buying at $120 silver and $5,600 gold, institutions were selling. Hedge funds were closing positions. Bullion banks were widening spreads. Smart money recognized the leverage problem. Northern Star Resources reported a 49% profit surge on February 12. Gold producers with unhedged portfolios captured the full upside. Royalty companies like Metalla posted record revenues. They sold into strength. Retail bought at the top. This is the oldest pattern in markets. Institutions distribute to retail at peaks. Retail panics and sells at bottoms. Institutions accumulate again. The transfer happens every cycle. This crash was no different. Silver producers saw their stocks shredded. First Majestic Silver dropped violently despite benefiting from high silver prices. Pan American Silver collapsed in pre-market trading. The underlying commodity crashed 17% in a single Asian session on February 5. Equity followed. Let me show you what the data reveals about who was positioned where. The Commitment of Traders report for late January showed commercial traders, which include bullion banks and producers, were net short both gold and silver. Speculators were net long at record levels. This is a classic setup for a flush. Commercial traders use futures to hedge their physical positions. They sell futures when prices rise. They buy futures when prices fall. Speculators do the opposite. They chase momentum. When margin requirements increase and force liquidations, speculators get crushed first. Commercials profit from the unwind. The flash crash on February 5 showed how thin liquidity really was. Silver tested $90 early in the Asian session. Within hours, it dropped to $74.80, then $72. A 17% move in a market with supposed robust demand. That tells you leverage, not fundamentals, was driving prices. Automated trading algorithms accelerated the decline. Delta hedging by market makers forced additional sales as prices breached support levels. Algorithmic sell orders triggered automatically. This created a mechanical failure in market structure. No human intervention could stop it. By the time U.S. markets opened on February 5, the damage was done. Gold stabilized around $4,600. Silver found support near $68, but the psychological damage was severe. Retail investors who bought at highs were underwater by 20% to 40%. Now here is where most people completely miss what happens next. Let me show you the historical pattern that explains everything. Go back to August 2020. Gold hit $2,075 per ounce. Silver reached $29.77. Everyone said metals would go to the moon. Then gold crashed 17% in 3 months. Silver fell 35% in 4 weeks. What happened after that crash? Gold bottomed at $1,716 in November 2020. Then it spent 18 months consolidating. By March 2022, gold was back at $2,050. The correction was brutal. The recovery was inevitable. Here is why that pattern matters now. After extreme parabolic moves, metals always correct violently, then they consolidate. Then they resume the primary trend. The primary trend is determined by fundamentals, not speculation. So what fundamentals have not changed despite this crash? Let me give you 4 structural factors that remain completely intact. Factor 1. Central bank buying. Central banks added 1,037 tons of gold to their reserves in 2024. That was the second highest year on record. China, India, Turkey, and Poland were the largest buyers. These institutions buy physical gold, not paper contracts. Their demand does not disappear because COMEX speculators got liquidated. Factor 2. De-dollarization. The BRICS nations announced expansion of their payment systems in January 2026. Russia and China settled $260 billion in bilateral trade outside the dollar last year. Every country watching U.S. sanctions realizes dollar reserves carry political risk. Gold is the only universally accepted alternative. Factor 3. Government debt levels. U.S. national debt crossed $36 trillion. Japan's debt-to-GDP ratio exceeds 260%. European nations are running persistent deficits. When governments cannot service debt without currency debasement, gold becomes the hedge of last resort. Factor 4. Supply constraints in silver. Global silver mine production peaked in 2016 at 900 million ounces. It has declined every year since. Meanwhile, solar panel installations grew 30% annually, electric vehicle production doubled, industrial demand is structural, not cyclical. The supply deficit does not reverse because prices crashed. Now let me give you my on-the-record prediction. Screenshot this. Gold will retest $5.0 by April 2026. Silver will reclaim $90 by May. The consolidation phase lasts 6 to 10 weeks. Then the primary uptrend resumes. Why am I confident? Because the mechanism that caused the crash was technical, not fundamental. Margin increases, forced liquidations. Once leveraged positions are cleared, the underlying supply-demand imbalance reasserts itself. Central banks are still buying. Industrial users still need silver. Nothing about those facts changed. Let me show you 3 scenarios with assigned probabilities. Scenario 1, probability 55%. Metals consolidate between current levels and 15% higher for 2 months. Gold trades in a $4,600 to $5,300 range. Silver oscillates between $75 and $95, then breakout occurs in April. Scenario 2, probability 30%. Another flush happens. Gold retests $4,000 to $100. Silver drops to $60. This would represent a 50% retracement of the entire rally from October lows. Markets find strong buyers there. Recovery is faster and more aggressive. Scenario 3, probability 15%. Geopolitical crisis accelerates the timeline. Military escalation, banking crisis, or currency crisis triggers immediate safe haven buying. Gold gaps to $5,500 overnight. Silver follows. This is the tail risk scenario that always exists in metals. Now let me give you practical takeaways based on who you are. If you are holding physical gold or silver, you do nothing. Physical metal has zero margin calls. You cannot be liquidated. The price on your screen is paper market noise. Your insurance policy did not disappear. If you are trading with leverage or holding futures contracts, you just learned an expensive lesson. Margin requirements change at the worst possible time. They always increase at tops. They always decrease at bottoms. If you survived this, reduce your leverage by 50% immediately. If you are sitting on the sidelines with cash waiting for opportunity, you are watching it unfold right now. Gold under $4,800 is a gift. Silver under $80 is historically cheap. Given supply fundamentals, the question is not whether to buy, it is how much and when. If you bought at the top and you are underwater, you have 2 options. Average down at these levels if you have dry powder, or hold through the consolidation. Selling now locks in your loss. Markets do not move in straight lines. Volatility creates opportunity. Now here are the specific indicators you need to watch going forward. Watch the DXY dollar index. If the dollar breaks above 110, metals face additional pressure. If it stays below 108, the path higher reopens quickly. Watch COMEX registered inventory levels. Registered silver inventories dropped 70% between 2020 and 2024. If physical drawdowns accelerate while paper prices are low, that signals the next supply squeeze. Watch Chinese economic data. China is the world's largest gold consumer and industrial metals buyer. If their stimulus measures gain traction, metals rally. If their property crisis deepens, industrial demand weakens. Watch central bank gold purchases. The World Gold Council publishes monthly data. If central banks accelerated buying during this crash, that confirms institutions view current prices as cheap. If they paused, it signals caution. Let me tell you about 3 types of people watching this video right now. The first type is panicking. They bought silver at $115. They are down 35%. They are asking whether to sell. They will probably sell at the bottom, then watch metals recover without them. The second type is frozen. They want to buy, but they are scared. They are waiting for confirmation. They will finally buy when gold hits $5,500 again. They will miss the entire move from here. The third type is learning. They are studying market structure. They understand leverage risk. They recognize the difference between paper and physical. They are building positions methodically. They will be positioned before the crowd realizes the trend resumed. Which type are you? Your answer determines whether you profit from volatility or become its victim. Here is what you need to understand about wealth transfers. Markets exist to move money from emotional traders to disciplined investors, from the impatient to the patient, from those who react to those who analyze. This flash crash was a massive wealth transfer event. Retail speculators with 20x leverage lost everything. Central banks bought physical gold at a 20% discount. Institutions accumulated. The pattern repeats every cycle because human psychology never changes. Remember what I said at the beginning, $6 trillion erased in 60 minutes. Now you know it was not erased, it was transferred from speculators to accumulators, from paper traders to physical holders, from those who chased to those who waited. The crash revealed who understands markets and who was gambling. If you learned the lesson, you are ahead of 95% of investors. If you ignored it, the next crash will teach you again. Do me a favor, smash that like button. Subscribe if you want to understand what actually moves markets. Share this video with someone who bought metals at the top and needs to hear this. They are probably panicking right now. Drop a comment and tell me this. Are you buying this dip or waiting for lower prices? I read every comment. Your answer tells me whether you understand what I just showed you. The next 60 days will separate those who profit from volatility from those who get destroyed by it. I will be here breaking down every move while mainstream media keeps you distracted. See you in the next one.